Hi, this is my attempt to explain finance, not only through the prism of finance, but also including psychology and neuroscience, because a lot of times we know what we need to be doing, we need to be saving, we need to be investing, and yet we still don't do this. And I find it fascinating that oftentimes we know what needs to be done, and yet there are blocks, fears, or simply like there's no time, whatever it is that prevents us. And yeah, I got interested in this area over 10 years ago, because I realized that despite the fact that I'm a trained economist and I've been working in financial industry for over 15 years, I haven't been investing myself. And then I thought like, oh, maybe something is wrong with me. But I asked around my friends and they pretty much had the same experience, that we all knew the the theory and yet nobody was applying it. And yeah, and since then I started researching it and doing the workshops and sharing. And this is my attempt to explain finance and psychology in a very simple manner so that you can start applying it to your life and also understand that there's nothing wrong with you. And hopefully just make this topic a little bit more easy to understand. So without further ado, I'm going to dive in. And first, I want to touch on the fears and blocks that we all have, that we often feel that finance is too complicated, that it requires a lot of brain power to set it up, and we need more time in order to understand it. Maybe we need a PhD before we start investing. But it's a misconception. I think if you understand the basics, you can set up a simple investing plan, which is going to cover some of your needs. And then if you're interested in this, of course, you can research more and educate yourself about more important, more interesting or more difficult products that exist in finance world. But with the basics, you pretty much can cover 80% of your needs. Another fear that I often hear, that it's scary and risky because we do not understand this. It's true, but understanding comes not from intellectualizing, but from doing. And oftentimes people think like, oh, I need to put all my savings into it. And it's simply not true. You can run like a small experiment. And I'm a big fan of this, that you run hypothesis. So you take maybe 10 euros, 10 pounds, whatever is your currency, and then see what happens to it. And thanks to all the infrastructure that is being built now, like you can start investing with 1 pound or 1 euro, it doesn't matter. And then you observe what is happening to the investment, how your body reacts to it. Are you getting excited? Are you getting scared? Like, what is going on? Because it's really important in investing, it's really important to understand your behavior. It like another block is, oh, it's too late anyway. The market is overvalued, and probably you hear this a lot, especially with AI bubble. Everyone tells it's a bubble. Other people say it's not a bubble. Some people say it's everything's going to crash. Others say it's not. It is hard to say, especially when there's so many opinions. And this is the time when the only thing you can do is just to try for yourself. And maybe it's a bubble, maybe it's not. The world is too complex to understand, but there are ways how you can structure your portfolio in order not to be burned too much. But yeah, one of the phrases that I really like, you have to you have to risk it to eat the biscuit, and essentially you have to play the game in order to win. But of course, it comes with the fact that you might lose as well. Another block that I hear a lot is that investing is for millionaires only. And it's true. Everybody who has money, they invest, because the bigger is your capital, the bigger is going to be your return. But you can start with as little as 10 euros or 10 pounds. Now there's literally, no barrier to entry. And this is how you actually earn money. And another, my favorite one is, oh, I'll do it tomorrow. And we're big on delaying things that are important to us because we think we need to be prepared. and spend time in order to research it, especially now there's so much information and we are constantly bombarded by all the things that we need to do. It's like, take care of your mental health, you need to exercise, and what about the health diet plan that you're taking, and have you developed your creative side? And here comes investing as well. But in a quiet moment, when you have one, if you have one, I hope you do, sit down and think about the things that are actually important. And I think, as much as it is uncomfortable, looking after your finances is one of the responsibilities of an adult. Yeah, I don't like that part either, I must say. So investing is actually only 20% is financial knowledge and 80% is psychology and discipline. And that's why I think it's important to start with a very small amount to invest, because you will observe how your nervous system reacts to like to things. If something falls like 50%, say you buy a share and it falls 50%, what will you do? Will you sell? Will you be able to deal with the fact that you lost, or will you be like, you know what, that's fine, I'll just buy more? We all behave differently because the nervous system acts differently for different people, and you need to understand how yours work. So the real enemy of investing is actually doing nothing, because inflation quietly erodes your savings. Currently, the inflation is around 2% in Europe, and I think around the same in the UK. So basically, inflation is your money lose the purchasing power, and time is the only thing that you cannot catch up on later. And yeah, we hear a lot in the news about market crash and everything, but the biggest enemy is actually missed years of compounding. And later on, I explain what compounding is. So, but before you start blaming yourself that like you should have done something earlier, I just want to give you a little bit of perspective. So humans sort of developed into what is considered to be a human around 300,000 years ago. And the agriculture developed around 10 to 12,000 years ago. Why is it important? Agriculture is basically our ability to plan long term. It means like the grains that we find, we were not about to eat them straight away, but we could think like, right, next year there's going to be spring, and I need to put something away and store something in order to grow another crop. This is pretty much the beginning of your long-term planning. It's only 10,000 years old. So, and then we have the model financial system, which is around 200, 300 years old. So think about it this way. For 95% of the human history, humans as species, we only cared about now. That's why it is so hard to put the phone down when we're just watching this exciting video on TikTok, or just eating a cake, which we know we shouldn't be eating at 11 o'clock at night. But we're like, you know what? I can treat myself. Our brain is basically not wired for long-term planning. And maybe in another 10,000 years, if we're still here as species, we will be better at it. But essentially, we're just not wired for long-term planning. And yeah, just for the last 3, 4 years of our 4% of the human history, we learned how to store food and plan in seasons. And investing is basically only 0.1% of the human history. So it's not in our DNA, if you want to say, or the habits to invest. So that's a little bit of compassion to ourselves, if we haven't done it already. And yeah, and now we can see what we can do with this. So some basics that you need to know. Inflation, as we've mentioned earlier, it is the rise in prices over time, and essentially it reduces your purchasing power. Yeah, think about what you could have bought like for £10 or €10 10 years back, and what you can buy now, or like price of coffee. 10 years ago and now. It has increased, hasn't it? So yeah, there's part of inflation. Inflation happens because the governments print money. Think like a massive input of money during COVID, the government had done. Essentially, there's also the inflation can be for different reasons. So government printing money is one of the most common ones. Another one is there's more demand on the goods that are being produced, or high cost for using this, well, for producing goods, right? Or there can be also on expectations of the fact that the price will increase, which happens now with oil, so the fluctuations. If your money grows slower than inflation, you basically get poorer in real terms. And sadly, the interest rate that the banks give you on savings account is very rarely matching inflation. Usually it's a little bit above or a little bit below, but yeah, in the long run, it's you cannot save by putting money into the savings account. And over 20 years, even moderate inflation can significantly reduce the value of savings. Now, interest rate is the price of money. And when you save, the bank pays you for using your money. But when you borrow, for example, you take a mortgage or you need a credit to buy something, you pay the interest. And that's the cost of using money. And yeah, the real return is basically the growth minus inflation. So because the economy is growing, we try to make the economy grow. So how can you save money? So three very basic ways. You can put it under the pillow, safe, and it's in your house. You can put it into a saving account, which going to give you a very small interest rate. And having it under the pillow, you will not earn anything because you're basically holding the money. When you give the money to the bank, you can earn small interest rate with the bank, or you can invest. And investing, you can buy shares of individual companies. You can buy a broad market, so invest in the economy as a whole, of a global economy of a particular country. Or you can loan the money to the government through bonds, also another way of investing. So, like I said, you can invest into the broad market, and oftentimes it's represented through ETF. ETF is exchange traded fund. The best way how I can explain it, it's you buying a box of chocolate. So, say you're going to your friend's house and you want to bring some treats, but you don't know whether people like white chocolate, dark chocolate, milk chocolate, truffles, praline. So you just buy a box, and surely this way somebody will find something that they like. And ETF is essentially is a basket of many, which consists of many different investments. So there are going to be like some companies that produce food, others that have work with AI, others that produce hardware for computers. So lots of different companies. And what it does, it offers you diversification. If there's a problem with one company, surely the others may not experience the same problems. And this way you can reduce risk. ETFs are usually low cost, and it's a simple strategy to own global markets. And you don't have to think like which company to choose. Is the company is doing well? You don't need to understand their financials if you're not from that world and if you're not interested. If you are interested, by all means, go and do this. But for the majority of people, we just want to live our life and, spend time with our friends and family, go traveling and enjoy the sun. And this is one of the ways how you can make sure the money works for you. So one of the questions is like, why does it all grow? Because innovation drives long-term growth. Think about it again in terms of human history. First, we were just running around, just trying to survive and not to die from hunger and cold. And then somebody just figured out like, hey, we can use fire in order to warm ourselves up and to cook the food and preserve the food, which was like massive innovation. If you think about it, it just changed the life. Then we started developing language. Then we realized that, hey, we can save things because, if we save some seeds, we can plant and have a harvest next year. And this way we sort of minimize the risk of us dying. Of course, there were other risks as well, but you try to do your best with what you have. Then the printing press was developed, and we could share information more freely, not only through spoken word, but through communication where things were not being as distorted. Then there was industrial revolution, internet, and now we're in AI revolution. And essentially what it does, it leads to increase in productivity, and that leads to economic growth, and that we live better, and the whole market grows, despite the fact that now we see a lot of problems in the world. This is the best times that we have lived in. We have like great, well, we have a great medicine. Of course, it could be better, but in theory, we have like very good medical system. We have some support from the government. Again, questionable whether it is distributed correctly and efficiently, but as such, we have. If you think like 200 years back, most of the things we didn't have. And essentially, when you're investing in a large market, you're investing in innovation and human development. So, like I said, the most important thing of investing is the idea of compounding. And it's Albert Einstein called it the eighth wonder of the world. Sorry. So essentially, it is you earn money, not only what you invested, but you also earn it on interest that you've earned. And it's like growth on top of growth. I try to explain it with a graph here that the longer you do it, the more you benefit from compounding. So principal is initially what you've invested. Say you put like £100 or €100 into your account, and then over years you've been adding the same amount. For example, £100, or doesn't matter, £10, whatever it is, over the years. But as you see, as the years go by and the life goes, the biggest amount that you will benefit from, not from the fact that you're saving, but from the interest that is being paid on top of your interest. And I'm going to try to explain it to you with a €1 and 10% interest rate over 5 years. So in the first year, you invest €1. As the year passes, you receive an interest of 10%, which is 10 cents, right? So the first year, you can see you earn 10 cents. Then you do not take those 10 cents out, and it means that your initial deposit for a year two is already €1, 10 cents. That is given that you do not add anything else. Like there's no additional deposit that you add up. So in the end of the year two, you will receive 11 cents of interest, not 10 cents like in the first year, but already 11, because you've been paid interest on your interest of 10 cents from the first year. And as you can see, if you do not add any more deposits into your initial saving, and if you do not take out the interest, then essentially by the end of year 5, you would have €1.61. If you would be taking your 10, like if there wouldn't be compounding, you would be at €1.50 without compounding. I hope you understand that. Like if you need, pause this slide, have a look, like play around with this. But this essentially is the most important principle of investing, and to be honest, of life, because the more time you invest into something, the better you become. Think about you playing piano. Everything is based on compounding. The more we invest time, the more we invest our energy, the better we become. And yeah, this is our development. So I can just maybe learn to play piano on every Monday. But if I do it Monday, Wednesday, Friday, like my learning skills, my muscle memory will develop faster. And I have repetition, I have continuation. Whereas if I do it like first Monday of every month, I will not have the same skill set as somebody who trains like 3 times a week. Um, just to give an example, yet another one, because a lot of people say like, oh, but you need to have a lot of money in order to I start investing. I'll give a simple example of investing 10 euros over monthly over 15 years. So from your pocket, you will put over the 15 years 1,800 euros over 15 years, right? So it kind of looks a big amount, but also not a big amount because it's 10 euros every month. So what, like 2 coffees you're not drinking a month, a bit of a detox, maybe, not that. And what would happen if you would put this money, which you gladly automate and easily can automate these days so that it goes out of your bank account. If you put it into savings at a rate of 1.5%, the final value after 15 years will be 3,100 euros. So you will gain 400 euros over 15 years. Doesn't make sense really, does it? If you would have invested it into the broad global market, saying that I know that the world's economy is growing, maybe it's not growing in Spain, maybe it's not growing in Germany, but maybe somewhere else in India or China or America is growing. So if you would have invested into the biggest company of the world, you would have gained almost 5,000 pounds extra. If you would have invested in the American economy, which is S&P 500, so the largest 500 companies in the US, you would have gained 7,000 euros. And yeah, we all know about the crazy technological companies spree over the last 10 years, 15 years, sorry. You would have gained 11, well, almost 12,000 euros. Now, the point of this exercise is not to show you that, oh, you should have invested into the fin into tech companies. The point is to show that the savings, with savings, you really don't earn. And yeah, if you invest in a broad global market, the return is still better. Obviously, it was not as great as if you would have invested in the into tech companies, but it's still bigger. And like 5,000 euros versus 400, good. Yeah. This is a little bit of a hypothetical example, but it's nice to kind of put things in perspective. So MSCI World was started in 1970s, so roughly 55 years back, and it gave roughly 10% nominal return, and in real terms it was 7%. And I know that euros didn't exist back in the 70s. I know that. But imagine, say you were born in the 70s and your parents were super progressive and they were putting 10 euros every year into an investment account. I know that it was not possible, but it's just to show you the compounding. So they were putting the equivalent of 10 euros into the savings account in your name for the 54 years. And they totally would have invested 6,480 euros from their own pocket. But you would receive now in 2000, well, now we're 26, but it doesn't matter. Like in 2024, you would have received the nice chunk of 140, almost 5,000 euros. And yes, it is 54 years ago, and the action was done for 54 years, but it was not a massive loss for your parents to save a bit of money. And then imagine that's a nice that's a nice present to receive. with a very low effort thing. So one thing, just to sum it all up, that long-term investing is not betting on one company. It's investing in the progress of humanity. And as you can see, we are living better. Things are developing. If you are not interested in financial markets, but you want to save the money, the best bet is for you to invest into a global market. And if you're a little bit interested, of course, you can read the financial news and just maybe invest separately in the economies of the US or China or whichever other industry or country or industry for that matter that you believe in. But this is only if there's you feel an interest to go and figure it out. And as my favorite, one of my favorite investors says, that Warren Buffett, that pretty much for the majority of investors and for majority of people, the best way is to buy a broad index fund, because we don't have the capacity to track the stocks. We're also not trained to deal with our anxiety around the money, and we're notoriously bad at understanding when to buy and when to sell. So it's just a consistent effort of doing something over a period of time, long period of time, and then you'll see the results. And like I said to you before, it all sounds weird, but just try it with €1, because I might be telling you here for years about it, but unless you try and unless you see it in your own account, you will not believe it. The best thing you can do is just to run this small experiment. Way better than listening to 500 courses of 500 YouTube videos. So, just again, to give you the numbers, here I have Spain as an example. The savings rate is pretty low. You can compare with inflation. That was in Spain, it's around 3%. So you see the savings rate was not even covering the inflation that was happening in Spain. The MSCI World index, so the broad index of companies that are operating in the world, roughly brought 15% a year, well, over the 3 years. And the US economy has been very strong. It's been growing around 18% a year. I'm just averaging between all of the years. And yeah, tech companies showed like an insane growth. So yeah, just to give the numbers and to understand that you have to play the game. Of course, there are years when the market doesn't grow as much, and there were plenty of periods over time, but the downturns always followed by the rising market again, and that's why it's important to consistently be playing the game. So the magic formula of good investment is to own the global market, to invest regularly with automated payments to your investing account, which you can set up easily these days, and ignore the noise and review maybe once a year in case your situation changes. And yeah, this is long-term investing. It's not like quick money. It's not like, oh my God, like I put €1 and then I next next week I had 10,000. Of course, these cases happen, but they're rare. And it's like winning a lottery ticket, right? But this is a proven formula which will deliver results over time, right? And good investing is boring. If it feels exciting, you're probably doing it wrong. It should be boring, and for a reason, because when you're excited, your prefrontal cortex is not working, and you might have a blurry vision of what is good for you. So all these things that I've been talking about, it's long-term planning for your pension or for your project, or for your kids, or just for your future life, man. It's like I said, 10 euros, 10 pounds, they're not crucial, I hope, for you. Yet you can save quite nicely for you in the future and have a nice life and do something nice with it. Um, so the long time horizon important, because only then you can see the compounding at actual work. So you can invest for kids' college fees, or for the house deposit, or for your pension, or for the big trip that you want to do. Like maybe one day you want to do like a cruise around the world, some crazy project, whatever it is, right? Or buy a farm in Tuscany, whatever. But not now. Um, no need to react to short-term crashes. Markets do recover, but overall trend is up. We become efficient, we create more new technologies appear, so it's an upward trend. Small amount become meaningful through time. So compounding is important. Every little helps. If you think it's not enough, please just go back to the slide where I showed you what you can do with 10 euros. And discipline matters more than performance. It's boring, and let the compounding work for you. And this is how actually smart money works. People who have money, they don't do crazy trades. They consistently invest into boring products, and if they have some excess, or if they feel adventurous, they have like a special pot of play money where they do all sorts of crazy things. But the majority of their wealth is stored in boring financial products like MSCI World, S&P 500, or bonds. Now, how to start? And this is where a lot of times people stall because they understand the theory, but we go, okay, I understand it, but where do I start? So I'm trying to make it really practical here. So you need to choose a broker. And oftentimes we just go down the rabbit hole trying to find the best broker with the best fees and the best platform and whatnot. It doesn't have to be perfect. Just go to any AI tool that you use and put a regulated, low cost, simple broker in your country. It needs to be regulated. It protects you from the fact that if the broker fails, your money is secured. It doesn't protect you from the market downturn, but if the broker fails, it means that the government will return you the money, right? But only if the broker fails. It's like if the bank fails, the government returns you the money. So, and yeah, basically, done is better than perfect. Again, set it up, trial it out with your 10 euros, and then if you get interested in the process, you will adjust. You can always move your money to a different broker. The fact that you have like 10 euros there, it's not a big of a loss. So maybe you'll open another account, because like me, for example, I have one broker for a boring investment, which I do not open. I just have my monthly subscription to it, like which is automated. Like I add to my long-term portfolio, and then with another broker, I have my play money, or where I go, oh, interesting. Let me run this hypothesis. Let me see what happens here. Is my understanding of the world correct? So yeah, they're separated. So what's next? Once you open the broker, you need to choose a low-cost ETF. ETF, like I said, it's a broad basket of companies investing in the global economy. You can choose MSCI World. There are different providers. It's the same as with chocolates. So you can buy a box of chocolates from Cadbury, or from Lindt, or from, I don't know, whatever other chocolate companies there are. But essentially, you can find one that is available on your broker platform, and check that their total expense ratio needs to be lower than 0.2%. But again, AI will help you there. If you filter out the ETFs that are available on your platform and ask AI to help you find the best one, it will tell you which one. When you're buying an ETF, an important thing to pay attention to is that you need to buy ETF that is accumulating version. Basically, what it means that all the interest and dividends that you receive from holding that ETF, they are reinvested back. This is important because it adds to your compounding. So basically, it helps you to earn interest on top of interest, and you don't have to worry about taxes yearly. Because if you would want to receive your dividends to your account, which you can set it up, but it means that you have to fill in a tax form every year and you will not benefit from the compounding. So this is a boring investing that you will not reap any benefits of it now, but later on you will be grateful. Essentially, think about it this way. This is an activity that you're doing that the future self will be very grateful that you did. You'll be like, man, I was so smart. Thank you. Thank you, past me, for doing this. This is how you should be thinking about it. The third step is that you need to automate monthly payments into your investing account. And even if it is 10 euros, 50, it doesn't matter the amount. The fact that you are setting a system of consistently adding to your future is important. I I'm amazed how easy it is to do it now. And I'm so grateful that we're living in these times because it hasn't been never has there been a time to do this easier than now. You don't basically have to remember anything. There's no decision-making fatigue or stressing about it. Just set it up. This is the time when consistency is more important than your intelligence. So set it up. It's done and dusted. There's going to be temporary discomfort in setting it all up, but once it's done, it's for life, man. It's you really taking care of your financial health in the future. And yeah, and the last step, most importantly, is you need to forget about it. Basically, do not check every day how's the market doing. Do not listen to the news because it will add to your stress. Just you can check it once a year, maybe, in case you're interested. But to be honest, half the times I'm not even doing that because I know it's just there and I'm not touching it. Because I know this is for my long-term planning, for my long-term needs. So here is an example of brokers that are available in Europe. It's just a table that I asked AI to do. So you compare it on ease of use, the costs, the access to different ETFs, whether you can set up the saving plan automatically. I would strongly recommend that you do one because then it just removes the burden of remembering what you need to put where from your head. And yeah, well, this presentation for a Spanish tax system. So, but you should not worry about this one if you are not withdrawing the money and if you are investing for long term, because all the money that you earn will be reinvested back into your fund and you will have to only pay your taxes once you sell. So now the ETFs, like I said, there are many different providers of the indexes. You should check what is available through your broker. But here I just give you a couple of examples. iShares is very widely known one. It's low cost. Xtrackers is low cost and a good one. Again, I don't know what's available in your country or with your broker, but these are the usual suspects. Vanguard is very good. It's been one of the biggest low cost index investing platforms and providers of trackers. So, so deadly sins of investing: never sell in panic, never stop investing during the downturns, and never try to time the market, because a lot of people go like, oh, everything's going to crash and then I'm going to buy. I've been hearing this for such a long time. And well, maybe some people can do this, but it's mostly a myth, because they run a study, and there are years when individual fund managers win over the market and they deliver like some crazy returns. But over a 5-year period, if you compare people who have invested into the broad market, like index investing, and people who have invested into the actively managed funds, only 20% of the funds are showing better results than the people who have invested into the broad market, meaning that over a long period of time, that discrepancy will be removed. So if it sounded a bit complicated, basically index investing is better. Just you don't have to worry, you don't have to do anything. This is the way to go. But people still play with these things because, like it some people are really good at it. Some people are entertained by it. Some people like researching and analyzing. And but if you have your own full-time job, if you have kids, and if investing is not your passion, and it's generally you're just interested in returns, you should invest just in a broad market. Um, One of my favorite quotes: do what you can with what you have where you are. Of course, you can buy a course on investing. Of course, you can listen to another 500 videos about investing, but pretty much with this, you can start now. Doing is better than understanding, than thinking. And oftentimes we get caught up in learning loop where we want to know more, and yet we never end up doing anything around it. Just to end up on a bit of, well, positive and compassionate note, human brain is not rational, sadly, and we have a lot of cognitive distortions, and we all basically experience them. But the fact that you are aware of them helps you to mitigate them. So one of them is the status quo bias, the fact that you're thinking that, like, because I kept my money in cash, I should keep on doing it the same way. That's not the case. It's like, oh, I have survived before, I will survive later. Well, yes, but you will not earn anything. Another one, cognitive distortion, is catastrophizing. Oh, the market crash is going to happen now. It's going to happen now. It can definitely happen, but we will never know when it will happen, how bad it will be, and it doesn't mean that it will never recover. We, like, our brain often thinks in black and white. It's either all like really really nice, or all everything is very dramatic, and that is not the case. Like, the truth is somewhere in the middle. So yeah, just observe how your mind thinks, and when it just goes into the we're going to lose everything, that is probably not the case. Even in the worst market crash, you still will have 30% left. When the Great Depression, like, everything fell like 70-80%, so you still had 20%. And yes, it took time to recover, but it did recover over a long period of time. Another one is availability bias. It's overweighting dramatic stories. So you hear like how people lose everything in the stock market, or how they win everything. And yes, these are two extremes. For majority people, we're just somewhere in the middle. Confirmation bias is you only pay attention to the news and opinions that support your fears. Stocks are dangerous, but you ignore the long-term evidence. The best way against this one is just trialing. It's you need to just put, like I said, 10 euros and just observe it. And then your nervous system will adapt to this because you will have new knowledge. All or nothing thinking is another common one. We feel like we need to do it properly with large sums, and do the perfect timing. But life is never is like that. It's always we're rushing somewhere. We're just trying to do the best we can, but we never can be fully prepared and fully ready to start investing. So I would say just start doing it now. And then action bias is actually one of my favorite ones. When you start feeling you must do something during the market volatility, even when doing nothing is statistically better than the move. So yeah, just some food for thought, just to remind you that despite the fact that we think that we are rational, our brain has a lot of bugs that prevent us from doing something that is good for us long term. And on that note, I hope it was useful and helpful. If you have any questions, please share them with me. I'll be happy to respond to them. I hope this video has been helpful and you have a little bit of a clearer idea about investing. Please do not be scared. Please start small. Like I said, investing is not about knowledge. It's about you understanding your behavioral patterns, your attitude to risk, and how you take the risk and uncertainty. Because for some people it's really easy, and for others it generates a lot of anxiety. We all come from different families, and there's a lot of family history and trauma around money, which I would also suggest you explore, because oftentimes we do not act because there are some beliefs around money that we don't deserve them, or that investing is dangerous, or you cannot trust the systems. Like, we all come with a baggage, but what I suggest you do is not blindly follow the pattern of what's been done for generations, but try to sit down and calmly look into it and run small experiments to understand what is actually going on. Does this belief serve me? And what will happen if I try a different behavior? Will it lead to a different result? And this is what I encourage you to do, not to invest all your money straight away into the financial market, but run tiny experiments to get more accustomed to risk, to money, and to your behavior under uncertainty. If you have any questions, I'll be happy to answer. Thank you so much, and bye.